T-bills will be more and more unattractive to investors in the future.
So what do falling T-bill yields mean for investors? And are there more attractive options out there for your money?
If they are looking at a relatively low-risk way to be able to secure the yield, the options are more limited at this point in time. And what this means is that investors may have to take on a higher degree of risk to be able to secure a higher yield. I would be putting my own money into some of these different asset classes mentioned, including Singapore REITs, including some of the high dividend stocks, as well as your bond funds. Because if interest rates were to come down at this point in time, then these are some of the asset classes that can potentially benefit from a lower interest rate. So one of the alternative asset classes that investors often look at to be able to generate income for their portfolio would be Singapore REITs. And we see some selected subsectors actually offering dividend yields of even up to 10%. So for example, if we're to look at the large cap REIT sector as an example, this would be REITs owning assets that many Singaporeans will be familiar with, including some of the shopping malls and office buildings. Then what we see is that the average dividend yield is actually at 6.6%. So this is actually a higher dividend yield compared to what investors are then able to get on the 6-month Singapore T-bill. What investors would need to be mindful about when investing in Singapore REITs would be that they are exposed towards the property sector, whether they are shopping malls or office assets, and that would be a risk that investors need to be mindful of, because that would then depend on the market demand and supply for these assets.
Market watchers say another option for T-bill investors is dividend stocks.
You can look at investing that in the Singapore stock market. You can either invest it in specific stocks, or you can just invest it in the STI tracker. Those would give you much higher than what the T-bills or what Singapore Savings Bond will offer. The Singapore stock market is wonderful because many stocks pay dividends, and you don't get taxed on these dividends. You don't get taxed on the income. So when you reinvest those dividends, it actually helps to compound the growth by reinvesting. If you don't need that money, you receive the dividends, you reinvest in the stock market, and that helps to compound the growth and make your money grow so much faster. The other part is capital appreciation, right? As the companies do well, as the companies grow, the companies that you choose to hold in your portfolio do well, they grow, they make money, they pay out dividends to the shareholders, their stock price goes up as well.
For many investors who are looking at high dividend stocks, they often start with a sector that they are familiar with, including the Singapore bank sector. So what we have seen for the Singapore banks is that they have been able to grow their profit in 2024, and together with that increase their dividend payout. At the same time, because they have a very strong balance sheet, so looking at it from a dividend yield perspective, the Singapore banks would then stand out as potential options for investors who are looking at dividend income. However, compared to the T-bill, they are definitely more risky because investors would then be exposed to the economic conditions which the banks would then have to be exposed towards, including a potential economic slowdown.
That's why we say that any money you need in the next 5 years should not belong in the stock market, because it is risky. You cannot control the share prices. It might go up or down. And if you need that money for an emergency, say tomorrow, and then you have to sell at whatever the market is, and that might not be doing justice to your holdings. So it is definitely, to us, a long-term vehicle. Anything more than 5 years, hold it for the long term. And also you must be able to be willing to accept some level of risk. Your capital is not guaranteed. You might lose some of that. So we always say the important thing is to diversify. Don't put all your eggs in one basket. Don't put all your money in one stock. Buy a variety of them. Choose names that you know. Do your research. Do your homework on them.
Another option is bond funds. These also offer potential for capital appreciation if interest rates continue to fall.
Bond prices typically go up when interest rates were to come down. On the other hand, because of the exposure towards bonds, what investors then need to be aware about is that then they are not capital guaranteed, because there's a risk of capital loss if interest rates were to go up, which will then effectively impact the price of the bonds. On the other hand, what investors are able to get through a bond fund would be diversification, because the manager of the bond fund would typically invest in a portfolio of bonds, and this can be across different bond types, maturities, or even geographies.
Singapore T-bills are short-term investments that are backed by the government. Yields have been trending downwards, with the latest at 2.73%. With the US Fed signaling potential rate cuts, this is likely to result in a further decrease in T-bill yields in Singapore.
If the interest rate is going down, it means that it's very likely 6 months or 1 year down the road, we may see something lower. And it may even go lower than, say, the CPF ordinary account interest rate of 2.5%. So increasingly, these T-bills will be more and more unattractive to investors in the future.
Despite falling yields, experts say T-bills are still a good choice for investors looking for a quick turnaround or a short-term place to park their funds.
I think it still has its place for people who say they are looking to maybe get married in 6 months, buy their first home, second home, buy a car in 6 months, you have this money, or perhaps you're a small business owner with extra cash, you know that you don't need that money, you can put it into T-bills for 6 months, 1 year, you know you're getting all your money back. Then perhaps the rest of the money that you want to grow your wealth, you want to look at retirement planning, you want to save up for maybe a big holiday, and many years later, your kids' university bills, whatever it is, right? You want to grow that.
Looking beyond falling yields, there's a bigger, long-term issue.
Investors need to ask, do I still think that this T-bill rate is attractive for me to park another 6 months or 1 year? So the problem with this T-bill is that you always have to face this decision every 6 months or even every year. And therefore, it's not meant for long-term investing. If you really don't need the money for the next 5 to 10 years, and you stretch out the horizon, I think investors are better off to look at a more balanced portfolio, not just looking at very short-term safe instruments that may not eventually beat inflation. Right? So they should look at maybe take a bit of exposure to, say, the stocks or even longer-term bonds to get higher returns over a longer period of time.